So does this mean now that those risk assets in the marketplace are, again, more attractive to those investors out there?
I think the market is starting to feel even more comfortable with the notion that the central bank is going to be an ally in this game. Remember that when Richard Clarida, the vice chairman, is telling you that their models are not infallible, they're talking about average inflation tightening, all that is a friendly message to the financial markets. And by the way, when they say that their models are not infallible, that's probably the biggest statement of the decade, because when you look at the inflation target of 2% and you compare that to core personal consumption deflator excluding food and energy, you have to go all the way back to 2008 to find a year where the inflation rate for that year came in at 2%. And by the way, this is not a criticism of the Fed. This is actually a positive statement, because maybe it's time to give themselves a pat on the back and say, we've done a great job, but now we can relax a little bit and let the inflation run a little hotter, or the economy to run a little hotter simultaneously.
We use the term Goldilocks so often in business news to refer to certain conditions. Right now, we have a situation where inflation, core, is relatively tame, yet wages are rising at a slightly quicker pace than many had thought it would. Isn't that a Goldilocks scenario for the U.S. consumer and, by proxy, the U.S. economy overall?
Oh, absolutely. Because now the consumers or the workers are getting a little bit more. They can actually spend more and the economy can grow faster. But the real wrinkle here, Dominic, is that when you look at the relationship between wages and overall inflation, that has actually weakened over the last decade. So when you see wages running a little hotter, and they're not too hot, because after all, the Federal Reserve wants average hourly earnings to grow between 3 and 4%, and we're at 3.4%. So they're not above that target, but a little hotter is actually good. And then you couple that with the fact that that relationship is weakened. There is no other way to go than to let the economy run a little hotter.
All right, so the economy may run a little hotter. What does that mean overall for the general environment on Wall Street? Does it mean cyclical sectors, economically sensitive ones like financials and technology, start to really assume leadership again in this kind of environment?
That's a great point. You don't necessarily have to go that far. You just say that there is support out there, because, let's face it, the economy, letting it run a little hotter is exactly what you want, because it is slowing down on its own. In the first quarter already, the Atlanta Federal Reserve is looking for economic growth to slow down to 0.4%. It may be only 0.5%. But we're not going to get the 2.9% growth that we got last year. This year, growth is going to come closer to 2%. So again, need a little bit of support, because the underlying trend in growth is a little bit softer. So I'm not so excited about the cyclical sectors at this time, is my short answer.